So we're not doing question 2. We're not doing the multiple choice. We are going to question 3. So it says, percentage of receivables approach to estimate bad debts expense is used by Hayes Company. On February 28th, the firm had accounts receivable in the amount of $555,000 and allowance for doubtful accounts had a credit balance of $370 before adjustment. Net credit sales for February amounted to $3 million. The credit manager estimated that uncollected accounts would amount to 5% of accounts receivable. On March 10th, an accounts receivable from Mark Doyle for $2,100 was determined to be uncollectible and written off. However, on March 31st, Doyle received an inheritance and immediately paid the past due amount in full. Okay, so we have to do entries for all of those, all right? So the first part, the percentage of receivables approach to estimating bad debts expense is used by Hayes Company. On February 28th, the firm had accounts receivable in the amount of $555,000 and the allowance for doubtful accounts had a credit balance of $370 before adjustments, okay? Net sales, we don't care about net sales. That doesn't matter to us, but they just put that information in there. Then it says the credit manager estimated the uncollectible accounts would be 5% of accounts receivable. Okay, so on the screen, we have the accounts receivable is $555,000. Okay, $555,000 is the accounts receivable. The percentage is 5%, right? So if we take $555,000 times 5%, we get, let me change this to money. So we're looking at the same thing here. Okay, we get $27,750. That's what we want the number to be, okay? We want the allowance for doubtful accounts to be this amount of money, right? 5% of accounts receivable. However, they told us that the allowance for doubtful accounts, right, had a credit balance of $370. And the rules tell us that if ADA has a credit balance, subtract that from what you want it to be. Get the entry amount, right? If the allowance for doubtful accounts has a debit balance, add that to what you want it to be to get the entry amount, okay? So this has a credit balance, so we're going to add that. So the credit balance is $370, right? We want ADA to be $27,750, right? $27,750. Hold on, I'm just making notes on the screen here so you can. ADA has credit balance of $370. So we're going to subtract it, okay? We're going to subtract it because that's what the rule tells us. So, let's see. So 27,750 minus 370 is $27,380. So $27,380 is what we want our entry to be for this problem, okay? So put entry amount. All right, so we're going to come down here. So our entry for they want us to prepare the journal entries made by Hayes Company on the following dates: February 28th, March 10th, March 31. So February 28th. Actually, I'm going to move that over one box. There we go. We're going to debit bad debt expense for $27,380. And we're going to credit allowance for doubtful accounts. Allowance for doubtful accounts. And I'm going to put in parentheses that that's the one we call the ADA. Okay. So we're going to credit that $27,380. Okay. So that's for February 28th. Okay, then what do they say? On March 10th. So on March 10th, an accounts receivable from Mark Doyle for $2,100 was determined to be uncollected and written off. So March 10th, they decided that they were going to write this debt off. They weren't. What was that? Oh, it's doing that weird thing with the dates again. Okay. March 10th. Okay. March 10th, we are going to debit allowance for doubtful accounts, the amount of the debt that we're writing off, and we're going to credit accounts receivable for the actual customer account of $2,100, okay? So let's see, this top entry here is the estimate ABA. This one here is write-off. The second entry is the write-off when the debt goes bad. Okay. The next one is March 31. It says, however, on March 31, Doyle received an inheritance and immediately paid the account in full. So when we have an account that's been written off, we have to first put it back and then post the payment. So if March 31. Oh, geez, you can look at that little booger. Okay. All right. So March 31, we have to first put it back. So we're going to debit accounts receivable for $2,100. And we're going to credit allowance for doubtful accounts for $2,100. Okay, and we're going to call that the put back. And then on March 31, we are going to post the payment. So when we post the payment, we're going to debit cash because we got a payment, $2,100. And then we're going to credit accounts receivable for $2,100, the amount of the payment. That is. All right, so it has the entry for the estimated. It has the write-off when a debt goes bad. And someone decides that after the debt went bad and we wrote it off, they're going to pay it. So you have to put it back. And then you have to post the payment, okay? So then they want you to assume no other transactions occurred that affected the allowance for doubtful accounts during March. Determine the allowance for doubtful accounts on March 31. Okay, so that's easy. You would just run a T account for this in order to do this. So let's go down, and this is what your T account would be. Let's do it over here. So this would be your ADA T account, right? So we would have the debit side, right? And you would have the credit side, right? And they told us that it started with a credit balance of $370, right? And then we would just go up here and go through the entries. So it started with a credit balance of $370. Then we debited, or we credited allowance for doubtful accounts $27,380. So we credited $27,380. We then debited allowance for doubtful accounts $2,100 right here on March 10th. Then I should probably put the dates there, huh? That would help you. That's beginning balance was the 370. Then on February 28th, we had the credit for 27,380. Then on March 10th, we had the debit for 2,100. Okay. Then on March 31, we had to credit for 2,100 to get rid of one we had written off, or the one we're writing off, right? We had to put it back. And then on March 31, oh, that's it. That's right, that's it, sorry. That's it. So our balance is going to be adding up all of the credits and subtracting the debits, because that's how we do the balancing of the account, right? We take the larger side, we add all those together, and then we subtract the smaller side. So the balance ends up being $27,750. That's the ending balance. And that was the question B for B. We want to know the balance. Okay. All right, so that's that for that problem.
Wait, could you scroll up so I could take a screenshot?
Yeah, hold on. Let me do that.